Well, M&A in the Permian Basin is breaking records this year. Now, the value of merger and acquisition deals in the oil-rich region in West Texas and southeastern New Mexico hit a total of $100 billion in 2023 alone. That's according to a report out this week by Wood Mackenzie. And this comes after Warren Buffett-backed Occidental Petroleum acquiring gas explorer Crown Rock for $12 billion this week. Now, with rates holding steady and the street betting on cuts by March, how are business leaders addressing mergers and acquisitions in the new year? Well, according to a new report out today by PwC, companies may begin to look at alternative deal structures. For more on this, Colin Wittmer, PwC's US deals leader, is here. Thank you for joining me this morning. So talk about these alternative structures. Of course. Talk about these alternative deal structures, especially as we consider the pressure that we're seeing from regulators.
Right. So we've seen clients get pretty creative in the way that they start to execute on transactions. We've seen transactions where it's up to a 49% interest so that the former private equity client could cash out a bit. You could preserve the capital structure so that you wouldn't have to refinance the debt, and then you can do another transaction later on. We've also seen precursors to M&A like strategic alliances, joint ventures, even licensing agreements, sort of to put your toe in the water, get a little bit more familiar with your partner, and then have that be a precursor to a larger transaction when the rate environment is more stable and improves.
And as we're looking at what we're seeing in the Permian Basin, what is it about that region? Is it just an energy story as we look at some of these large mergers and acquisitions versus sort of these smaller ones that are up and coming for 2024?
Yeah, I think it is largely what you just described for the Permian Basin. But if you think of our other corporate clients, M&A for them is basically business model reinvention. It's the quickest way to do it. Our clients that use transactions to transform their business, whether it be because of climate change, technological disruption, demographic shifts, a fractured world, social instability, put all that together, businesses need to reinvent their business model, and M&A is the fastest way for them to do that.
And usually, we've been talking a lot about recession here, and that's usually, prime time to start seeing this. Obviously, We're still not there at recession. The Fed might stick the landing. What does that mean for the types of deals that are going to be more popular going into the new year?
Right, and I think you're right. The jury's still out whether or not we'll have the soft landing, but it does seem as though things are trending that way. We are nearing the end of a profit recession. So if you looked at the S&P 500 EPS growth, we had 3 straight quarters of decline, but that has changed in the second quarter of 2023, and it's expected to continue. So that bodes well for M&A. Large transactions, I think, will still be challenging to get done, in particular with the antitrust backdrop that we've seen and how aggressive the U.S. government has been around antitrust actions. So very large transactions, I think, may take a little bit of time to come back, but there's lots of tuck-ins that our clients are planning to do right now just to transform their businesses.
And you note that tech, media, telecommunications, we're seeing those usually the most active sectors. Will that still be the case in 2024? We've also seen some action in the health space as well.
Yeah, and tech has always been one of the most active areas for M&A. I think it will continue to be active, probably not for the very large transactions and large companies because of what I mentioned about the regulatory scrutiny. But private equity is still very active in software as a service businesses and tech, as well as getting into things like cybersecurity. So I do believe tech will still be good. I am smaller deals in pharmaceutical and life sciences will continue to happen. And then of course, health services, which is sort of one of the least susceptible to the economic conditions. So those will always continue to be attractive assets as well.
And of course, tech, a huge space indeed. And we know AI, of course, stole most of the headlines so far this year. So as we look at some of the nuances within tech, and when we think of not just what US regulators are doing, but also European regulators cracking down as well, how do we see that affecting IPOs as well?
Yeah, the IPO market has been very muted for a while now. There were a couple of large IPOs that came out, but we haven't seen the floodgates open for the rest. So there is a big pent-up demand for companies to go IPO. Not exactly sure when we'll see that market open up. Hopefully it opens up in 2024, like I suppose the rest of M&A will open up as well. And as it relates to AI, all of our clients are interested in artificial intelligence really from 2 perspectives. One, are they buying a business that could be easily disrupted by artificial intelligence? And then secondly, how could they improve their businesses using artificial intelligence? And you get that really in spades from the private equity side of the business.
And especially for some of these more sensitive parts, obviously we're still in the very early stages of just how much some of these large language models will impact that. What does that mean when you think of things like national security now increasingly being tied into some of these deals as well?
Yeah, there's CFIUS has been an issue in the U.S. government, has been very critical of certain types of transactions where U.S. companies are moving things offshore or acquiring things offshore. I think that scrutiny, the CFIUS scrutiny on top of the regulatory backdrop of antitrust are just going to weigh on M&A for a while until that settles down.
We'll be keeping an eye on that as well. Thank you for joining me this morning. Colin Wittmer, PwC's U.S. Deals Leader. Thank you.
Yep. Thank you, Rachelle.